answering your questions about retirement. It's Money Talk with Michael Eastham.
We're getting close to retirement and keep hearing about Roth conversions. How do we know if it's right for us?
Roth conversions are a hot topic of conversation today because people realize that if you have money in a Roth, it's better than in a traditional IRA because money inside of a Roth IRA grows tax deferred and you can access it at some point down the road tax free. If you don't use that money, you can pass it on to your beneficiaries tax free as well. So that all sounds great, right? However, doing a Roth conversion, there's a cost to it. So you have to take into consideration whether it makes sense for you. And there's a myriad of things that you need to think about. Like, for example, what is your income going to be? Are you taking required minimum distributions or RMDs? How close is your income to the Medicare adjusted amount? That might bump your cost for Medicare up. So all of those things are very important to understand. Not only that, but remember, just because you do a Roth conversion doesn't mean that you don't pay tax on the money that you're converting. So if you take $10,000 and you convert it into a Roth, then you're going to pay taxes on the $10,000. And the actual rate that you pay is going to be dependent upon your highest marginal tax bracket. So it's very important that you have somebody that understands these calculations before you decide whether it makes sense. That's one of the things that we do with our clients is we help them make determinations about whether a full Roth conversion, a partial Roth conversion, or no Roth conversion makes the most sense for you given your situation. So it can be incredibly tricky. Not only that, but remember that once you pay the tax to the IRS, you've got to let the money sit in the Roth account so that you essentially pay yourself back the cost of the conversion. In other words, the taxes. Make sure you don't skip that very important part because you may be in for a surprise. One other element is that is related to the 5-year rule, and people get this confused all the time. There are 2 5-year rules. One is the 5-year rule that's based on age 59 and a half. Meaning that you can't touch the Roth money until you're at least 59 and a half. The other one has to do with contributions or Roth conversions after you're 59 and a half, but they still have to sit there for 5 years, or the growth or the income on top of that Roth conversion may be taxable. Don't confuse that with the principal, because the principal is not going to be taxable. It's just the gains on that account may be taxable if you don't meet those 5-year rules. So make sure you understand all of the tricks and the tools before you make a decision to do a Roth conversion. That's a great question. Don't forget to like and subscribe so that you continue to get updated content on a regular basis. Thanks so much.